Are you ready?
Ready.
All right, let's go. Kevin here, top 100 financial advisor and best-selling author. We are here to talk about the stock market. The Federal Reserve has spoken. They are going to raise rates yet again by 75 basis points, also known as 0.5%. This is the fourth time in a row that they have raised rates by this magnitude, and the fifth time they have done so in 2022. And yes, the year is not over yet. However, this is different. This rate hike is a bit different. There were some things that were, let's call it a little bit of a wrinkle that could give us a little bit of a glimpse into the future. So in today's video, we need to discuss what this particular rate hike means and what you should do as an investor, and more so what you should expect as an investor as well. So I'll do a very quick recap because obviously I've talked about rate hikes at least 5 times already this year. We know that this is their crusade to try and stop inflation. Is this the best tool in the world? No, it is not, but it's the only thing that the Federal Reserve can do is raise interest rates and lower interest rates. And when they raise rates, they make borrowing more expensive, and it discourages people on buying homes, discourages people to take out loans, buy cars, so on and so forth, to bring down demand and kind of bring those right in line with supply. You want supply and demand to be equal. That is not the way things have been. We have way more demand than we had supply. That is one of the reasons why we are where we are. Now, the other way to help fight inflation is to encourage, I don't want to say force, you can encourage companies to produce more stuff. Perhaps Congress can put out more funding for companies to produce more stuff to increase the level of supply. All that's theoretical. You're in a midterm election year. I don't know what they're talking about, what they're doing, but in either case, that ain't the Fed's job. That's not in their purview. So the only tool they have is to raise or lower interest rates. That's how we are here. Now, I'd already mentioned when the Fed raises rates, that makes loans more expensive. Anything that has to do with borrowing, 9 times out of 10 is going to be more expensive, and you probably already found that out. But also, this is great for savers, as you have probably found out as well. I think Ally Bank is paying like 2.3 or 2.5% every time the Fed comes out and says we're going to raise rates. I get a brand new email talking about my savings rate going up. Great for me. Now, the stock market reacts in different ways. Actually, I'll pull this up here in a sec. You'll notice that every time the Fed has raised rates, or the day that they announce that they're going to raise rates, the stock market has gone up 3 out of the 5 times. However, the last 2 times have been negative. We'll see what happens tomorrow, but the stock market tends to react. We also know, and this could be for our new viewers that haven't been tracking a lot of the interest rate stuff, because we've had a lot of new subscribers as well. Like and subscribe. Thank you for being here. I appreciate it. Aside from all of that, though, usually tech stocks, those stocks are not profitable and have to borrow to survive. Those are the ones that get hit the most, and you have seen that. That's why I'm not going to say all tech stocks, but the majority of them have been down, and have been down by 30, 40, in some cases like 80 or 90%. See Snapchat. Snapchat is not necessarily profitable. They have to take on a lot of debt, and the debt has just gotten more expensive just in the last, 12 hours or so. Those companies that are more profitable, that can survive interest rates and can survive inflation, like General Mills, like GPC, General Parts, O'Reilly's, AutoZone, a lot of the companies we've talked about before have done quite well during this time. So if you're looking for individual stocks, that is the direction you want to focus on. I talked about this yesterday. A whole list right here inside of our members only of 7 companies that you do want to consider. I actually gave you bonuses and gave you actually 10 in that video, but the moniker here, or the screenshot here rather, says 7. In either case, that's out there for you, pays dividends. Every company on there is up at least 30% on average. So you definitely want to check that one out. Aside from all that though, what makes this particular rate hike different, and what does it mean for the economy? Well, Fed Chair Jerome Powell came out and said that while this one is up by, or they're going to hike rates by 0.75%, this could be the quote unquote peak, that they could start to slow these rate hikes down. And that could be a sign of 2 good things. Okay, so when you raise rates, and the more you do it, the more concern there is that you are going to crash the economy. You're going to make things too expensive, and you're going to have what we call a hard landing, and that you, again, push us into a very deep and painful recession. This is what happened in the 1980s when the then Fed chair in the 1970s, 80s was Paul Volcker. He was famous for this, where he raised rates so fast that he crashed the economy, but he did win. He won inflation. He beat inflation, crashed the economy, and really set us up for the 1990s. We would prefer not to do that this time, but again, the only thing they can do is raise rates, and that's what they have been doing. However, he did say that, look, we raised it by 0.75 again. the next time, and these are basically his words, paraphrasing here, the next time that we raise rates, it might not be 7.5. Maybe it's 0.5%, maybe it's 0.25%, and we are open to the thought of flattening out these interest rates in 2023. So this could be the last time that we could see a rate hike of this magnitude, which, if you're looking to infer things here, we're raising interest rates. We've hit a peak to a degree. We're going to keep raising them, but not by this degree. That maybe the Fed is not going to put us into a recession. Perhaps this is the peak of this, and things are on their way to a soft landing and a decent recovery for the stock market. These are all theories and thoughts here. Okay, we don't know if that's going to happen. We still get inflation numbers every month, and there's a lot of things to start to play out. However, it seems to be they are open to slowing down these rate hikes, which could help the entire economy. Here are some other things that you do need to know, just to give you a picture of how these rate hikes impact us as investors and also as consumers. And I'll put this here. This is from USA Today. Mortgage rates are above 7%. Okay, that we know. However, this is the highest interest rate for mortgages in 2 decades. And for example, this rate hike adds an extra $1,000 per month for a home that is $427,000. That's a lot of money, an extra $1,000 per month. And if you tell me, because I was in the housing market at one point in time, around this time last year, actually. If you tell me now, because I waited 4 hikes, right? I now have to pay an extra $1,000, not once, but per month on my mortgage. Look, I might have to rent a little bit longer. I might have to move in with somebody because that's really expensive. And that's just this. They're not done. They're not done. The projections, and again, these are projections, not guarantees, from most banks like Bank of America, Morgan Stanley, and others. They're saying they are likely to continue raising rates all the way through 2023. They're probably going to be less than 0.75%, but they still are going to raise the expectation that this is not going to go away anytime soon. But also take a look at this. Home sales have continued to fall. Home sales have fallen for 8 consecutive months, and real sales are down 24% from September of 2021. Now, this was expected. I saw this coming a mile away. I think most people saw this as well. I did a whole video on why I thought the housing market was going to crash right here. And this was from last year. And that's because at some point, the housing supply, the cost and the price, how fast prices were in 2021 and 2020, that was not going to be something that lasts. And this is a part of that too. This is why they're trying to slow down. This is the effect of trying to slow down the economy enough to bring prices down. That is another example here. And the last one here is, I know we've talked about inflation and it's still high. However, the pace has slowed down. So an example here is the consumer price index dipped to 8.2% in September. This is the lowest annual rate since February. Now, when the inflation number came out, everybody panicked, 8.2%, this is bad. And it is, right? The goal of the Fed is to try to get it to 2%. So we are well above that number. However, it's slowing down. And just as slow as it was back in February of this year, which feels like forever ago, because we only got 1 month left in the year, y'all. That's it. That was 9 months ago. It is slowing down. It's not where we want it to be. In fact, it's 4 times what we want it to be. So there's a very long way to go. So those are the things that are kind of impacting the economy. As an investor, history still holds true here. Okay, history still holds true here in that we've already talked about this the other day. November through April tends to be the best month. This is a midterm election year. November tends to be the best month in a midterm election year. We also know the stock market tends to rise more often than it tends to fall. This was one of those times where the stock market fell over this particular year. Even though the Dow Jones, the 30 largest companies in the United States, was up 13% in October by itself. That did happen. A lot of people don't talk about it, but it did happen. And that is one of the things that I talk about all the time when we talk about investing. We always hone in on the negative. We know Facebook is down 60 some odd percent, right? We know Netflix at one point was down 50%, and that's up 50% over the last 6 months. But in either case, Snapchat, right, down 80, 75, whatever it is today. We always focus on that. Worst thing ever, 2008, all that kind of stuff. And then you had a great month. You're up 13%. Best October since 1976. Hey, great news. And we just glossed right past it and move on to the next disaster to think about. In either case, you still want to stay focused on the long term. If you're buying index funds, you should probably continue to do that, right? And in fact, I got a comment the other day that said that they're going to double down on the dollar cost averaging. And that's adding adding money on the 1st and 15th, every paycheck, and say, look, I was putting in $100, now I'm doing $200. I was putting in $500, now I'm doing $1,000, and start to really build up. And this is probably a time to do that. I cannot sit here and guarantee you that 2023 is going to be a positive year for the market. I can say, though, that even when the market is down, even when the market is hectic, or even when the economy, rather, is down, and unemployment can be high, inflation can be high, and things don't look great in the economy, sometimes the stock market does not care. And sometimes, because inflation was still high in October, was it not? Right? Did anything just really happen great in October from the economics part of things? Not really, but the market was up 13%, the Dow Jones to be specific. Even if you go all the way back to 2020, when COVID hit and the market fell 38% within like 45 days in March, after about March 15th or so, the stock market took off from April all the way through December, even though we really hadn't had vaccines yet, even though the situation had not really changed yet, and the market took off, and at the end of the year, the market was positive. We didn't really start getting vaccines until, October, November, December of 2020, even though the stock market had already taken off by mid-March. So sometimes they don't always match up. The economy can be bad, employment can start to rise, and the stock market says, look, we're looking to the future, things are great, we're going to move forward. So that is the hopeful part of what may happen in 2023 and what could happen the rest of this year. Could happen. I cannot guarantee that for you. What I can tell you, though, index funds almost always make sense. Yes, it is still a time for you to continue investing, in my view. And then we've went over several companies, including these here inside the members only, of places that you might want to consider investing that are doing well right now and that are poised to do well over the next 6 months to a year, which will carry you into 2023, and in which case we can come back and reevaluate. All right, that is it for me today. Again, make sure that you like, subscribe, and join the members only. That is your homework right now, and we did it. We did this in one take. I don't know if the kids are yelling in the background or not, and if that was caught on the recording, but it is what it is. All right, I will see y'all tomorrow. I've got a question that someone asked about index funds compared to the stock market, individual stocks. I want to get to that question this week, where I was going to add a new video like we do every single week inside the members only and keep things rolling. All right, I will see y'all tomorrow. Bye.